is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Bank earnings in the spotlight. Deutsche Bank and UniCredit lift their revenue outlooks as higher rates boost trading. For Barclays, it's a miss. Big tech battered Microsoft, Alphabet, and Texas Instruments tumble after hours as weak earnings hit some of the world's top tech companies. Plus, new Prime Minister Rishi Sunak appoints his cabinet as the Time reports he may delay next week's fiscal statement. So first thing is first, let's check on the markets. We actually opened lower after that slide because of tech earnings. A lot of questions on whether we've seen the worst of the sell-off. Reminder, we've lost some $5.5 trillion since the beginning of the year. And the question is whether that nears a bottom. European stocks, you can see pretty much flat. Banks, maybe a little bit under pressure, down some 0.3%. Although Deutsche Bank, our Danny Burgers in Frankfurt, bring us that interview. They did better than expected on a lot of metrics. Certainly their traders did better than a lot of the Wall Street banks. U.S. 10-year yield 4.04, and then the dollar index 132.1. The picture overall is not only one of earnings, and we do see a bit of volatility when it comes to that, but a lot of it is also what we do with central banks. So the ECB, of course, based in Frankfurt, comes out with an interest rate hike tomorrow. Then a week after, it's the Bank of England here in the UK. And then I would also watch this country, Italy, down some 0.2% for the markets. At the moment, not really latching on to that, but we had the first speech of Giorgia Meloni in Parliament yesterday, and she really went after the ECB, saying they should not hike rates. One of the feistiest speech against the central bank, certainly from a G7 country. Now, the British Prime Minister Rishi Sunak has named most of his cabinet, confirming Jeremy Hunt will remain Chancellor of the Exchequer, but Downing Street was unable to confirm if Hunt would stick to his plan to outline the government's spending and tax strategy on October 31st. Now, outside number 10, Sunak reiterated the tough economic challenges the country faces.
Right now, our country is facing a profound economic crisis. The aftermath of COVID still lingers. Putin's war in Ukraine has destabilized energy markets and supply chains the world over.
For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, Rishi Sunak appears to have kept his friends close, his enemies closer in his cabinet appointments. What does it say about how much experience he wants in his administration?
Well, he's rewarded experience, but also a firm nod to party unity. He's kept the same three holders of the great offices of state that Truss had just a week ago. And it's really avoiding the mistake that she made of surrounding himself with loyalists, though ironically that means that he is now surrounded by Truss allies. It also means that they don't need time to settle in. As you say, Jeremy Hunt is staying at the Treasury. He can deal with the crisis from the get-go, and instead Sunak has had to reward his allies with positions lower down the pecking order. So, for example, Mel Stride, his campaign chief, takes work and pensions, but that is an important role at this stage given the debate over whether benefits should rise in line with inflation, and Mel Stride has indicated that he favours that should happen. It also means that Suella Braverman remains Home Secretary just 6 days after she was sacked for breaking the ministerial code, just after Sunak has said that he's going to rule with integrity, but it's the result of him having to do a deal with the Tory right. That could be a point that is picked up at Prime Minister's questions by Keir Starmer today, and it also means no promotion for Penny Mordaunt, perhaps punishment for not conceding till the very last minute in the leadership race.
So, Lizzie, it's the first face-off, Prime Minister's questions between Rishi Sunak and Keir Starmer. What do you expect?
Well, it's billed as boring versus boring, Francine, but that's a welcome thing for many in Westminster and around the country, that we've got this new era of British politics, mercifully, many would say. One of Labour's main criticisms of Rishi Sunak when he was Chancellor, the line used to be, we'd do the same thing, but we would do more of it and faster. So it may be more difficult for Starmer to oppose Sunak. I would expect, as I say, criticism of the reappointment of Truss allies like Suella Braverman. It would suggest that Sunak agrees with the policy of sending asylum seekers to Rwanda when Sunak has promised compassion. But Sunak really headed off a lot of the criticism you would expect Starmer to make today. For example, calls for a general election by saying in his speech in Downing Street yesterday that he's going to deliver on Johnson's mandate from 2019, hence the references to Brexit, levelling up the National Health Service. He addressed the concerns about his predecessor's mistakes and the concerns as well that he's too rich to deal with people's real struggles in this cost of living crisis. But interestingly, a YouGov poll says that 2/3 of people continue to think that Rishi Sunak is out of touch with ordinary people.
Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Now let's get straight to Themos Fiatakis. He's Global Head of FX Research at Barclays. Themos, when you look at the UK, the most interesting bit is, of course, whether we have the fiscal plan, the Halloween budget, as it was dubbed, on Monday, because then on Thursday we have the Bank of England decision. If this gets delayed to post-BOE, how problematic is it for the Governor, Andrew Bailey?
I think a big part of how the Bank of England has basically described the problem is that you have a very difficult underlying situation and you have an overlay of fiscal policy which can either change the situation for more hikes or just reduce the amount of hikes that they need to do, but still the bias is for higher rates. There was a very seminal speech by Ben Broadbent last week that basically described that even in the presence of some fiscal easing, you would still need to undershoot what the market is pricing. And, you know, Sunak is probably standing for a little bit less fiscal easing than before. So the overall setup for the Bank of England is a setup where they need to hike, but less than what is priced in. And how far less will depend on the budget. And, you know, I think that they're, you know, for the next meeting, they don't have enough information to rely on in terms of that bit.
But Themos, I mean, I guess the market, and I don't know whether the market is under or overpricing this, right? But the market is afraid of what happened about 4 weeks ago, which is we didn't have the fiscal plan, the BOE does something, they're not aggressive enough, the market crashes. I mean, this time we had a call between the Chancellor and the Governor. So is it this time differently if two sides speak to each other? Does it really matter to the markets if the fiscal statement is postponed as long as they speak to each other?
A little bit, as you allude, a little bit less than before, for sure. And, you know, a big part of the reason is that the broader market assumption is that, particularly based on the market knowing Sunak's platform from his tenure as Chancellor of the Exchequer, that it's not going to be a fiscally expansionary platform. So at the end of the day, the trade-offs that the Bank of England is facing are a little bit less punitive. They don't have to do as much as they would have to do, let's just say, on the budget that was released in late September. So that part of the detail matters less. But as you said, you know, the key risk still for the market is that they get underwhelmed regardless of fiscal.
Okay, Themos, what's your call then on sterling going forward?
I think sterling probably weakens. The UK is facing two shocks. You know, obviously you have an external shock to energy prices that, notwithstanding the drop in natural gas prices, remains a very difficult shock to the economy, a stagflationary shock. The UK economy is also facing a decline in its labor force as a result of, Brexit conditions. And that seems to be an additional layer of weakness for the pound, an additional problematic zone for the Bank of England. The pound has stabilized because the Bank of England is now priced to hike more, and the Bank of England will likely not hike as much as they're asked to by markets. And in this setup, given that this new government doesn't show a signal that is going to particularly change the labor market situation by more migration, those dilemmas will probably stay. So this rally or relief that we're seeing for the pound, probably a little bit temporary.
All right, Themos, thank you so much. Themos Fiotakis there, Global Head of FX Research at Barclays. Now, coming up, we'll discuss all the action in the FX markets and the implications also of a surging dollar. That's coming up next, and this is Bloomberg. Later today also, you don't want to miss Youssef's exclusive interview with the Saudi finance minister at the FII conference in Riyadh. I know I'll be tuning in for that conversation on geopolitics. This is Bloomberg.
We are not seeing asset quality pressures yet. Obviously, this will very much depend on the type of slowdown that we face in the next few quarters, but the bank is better prepared than ever to withstand any asset quality deterioration that we might see. But again, we are not seeing any asset quality pressures at the moment in any of the markets where we operate.
Well, that was Santander's CFO, Jose Garcia Cantera, speaking exclusively to Bloomberg after the Spanish lender beat estimates. Now, in other earnings, Microsoft posted its weakest quarterly revenue growth in 5 years, thanks in part to a surging U.S. dollar. Now, here to discuss the implications of a strong dollar, Themos Fiotakis, Global Head of FX Research at Barclays. He's still with us. Themos, how much higher can the dollar go?
I think that we are probably at the last sort of like legs of dollar strength. It's pretty clear that, you know, a lot of the components of the U.S. economy are starting to show some peak, whether that is wage growth or whether that is inflation growth or whether that is, you know, the housing market, etc. At the same time, we had a very bearish view on Asia, given our view was that zero COVID policy was here to stay, and that would be an additional impetus for the dollar. Now this is a lot more recognized by markets past the National Party Congress. And last but not least, you have seen pretty big evidence that, you know, natural gas and energy prices can swing both ways. So a lot of that is in the price. The main risk here is, the main issue here for the dollar is that if you think about the balance of risks, it's still skewed to the upside. And what I'm saying by this is, you know, warm weather can become cold weather next month and natural gas prices can spike. Intervention is now stabilizing Asian currencies, but that may actually prove to be an entry point for investors in the future if policies remain geared towards soft growth. And we could see quite a few more months where inflation will go.
Sorry, Themos. So what does that mean for example, some of the emerging markets that you follow? If you look at some of debt denominated in emerging markets, maybe countries that, you know, have upcoming elections that are large, you know who I'm talking about, what does that mean for them going forward and their debt sustainability?
I think that you're hitting the nail in the head here. In this environment where, you know, the majority of the dollar move is behind us, but there's still some upside risk for the dollar, etc., one needs to understand that now the world is set up differently for different countries. There are some parts of the emerging universe that will benefit from some evidence of peaking in policy rates in the US. These are the high carry currencies with good balance sheets, Brazil, Mex. They tend to benefit when rates volatility peaks. Then there are countries that have a very high sensitivity to high rates, financial conditions, etc. So, you know, the fact that global rates will stay high is a bad thing for them. This usually touches on countries that have high financing requirements. The Andeans, Chile and Colombia probably stay under pressure. India and Indonesia probably still on the negative end. And then the tiebreaker of it all, both for G10 and EM, is how much weaker the Chinese currency will go and how big of an influence that will have both on regional currencies, EMs and the euro. And there's still probably on the balance a little bit more downside there to complete the picture.
Great. Themos, thank you. Themos Fiotakis, our global head of FX research at Barclays. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Europe suddenly has more gas than it can use. Starved of Russian imports, the region has filled storage facilities with LNG cargoes from around the world, combined with an unusually warm weather that's seen gas prices fall back sharply to less than a third of their summer peak. Bloomberg's weather model suggests European temperatures are set to stay milder than usual, and that will be well into November. Now, Australia's headline inflation has surged to a 32-year high in the third quarter, with consumer prices up 7.3%. Well, that was on a year ago. It came that day after the government warned of mounting debt and deficit in the year as ahead. The RBA thinks inflation will peak just under 8% by the end of the year. And Adidas intends to sell existing Yeezy product designs using its own branding after ending its partnership with the rapper and designer Ye, formerly known as Kanye West. The company expects a €250 million hit to earnings after terminating its relationship with the star over a string of controversial social media comments. Rishi Sunak has named an experienced cabinet to lead the UK through what he calls a profound economic crisis. Jeremy Hunt is remaining as a Chancellor of the Exchequer, but Downing Street has not confirmed if he'll stick to delivering a fiscal update on the 31st of October. Suella Braverman is back in as Home Secretary just days after Liz Truss fired her over a national security breach. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, some of the biggest U.S. stocks in tech tumble in after-hours trading following disappointing results from Alphabet and Microsoft. So we'll have plenty more on that next. This is Bloomberg.
European aluminium is really suffering from the war. And we see that there is a paradox that a number of the producers has been self-sanctioning in terms of the Russian metal, while there are others that are buying the Russian metal and are gaining from the war in many ways. So we see that we are now calling for an action to sanction Russian metal.
Well, that was the chief executive of Norsk Hydro speaking earlier to Bloomberg, calling for sanctions on Russian metal. Now, U.S. tech stocks tumbled in after-hours trading after some of the industry's biggest companies reported disappointing results. Now, Microsoft posted its weakest quarterly sales growth in 5 years, while Alphabet sales fell short of expectations. Now, chip bellwether Texas Instruments also gave a weaker forecast. Well, joining us now is Matt Bloxham from Bloomberg Intelligence. Matt, great to have you on the program, as always. So first of all, what were your key takeaways? It wasn't great.
No, it wasn't.
But did it warrant that much of a sell-off in after hours?
Well, it's always tricky, isn't it, with where people's expectations are really fixed. I mean, I think there were three things here. One, obviously, there's the currency headwinds, about 5 percentage points this quarter, a bit stronger than last quarter, but then clearer slowdown in advertising spending hitting Google, but also some signs that PC and cloud demand is also slowing too. I think particularly what Microsoft said about Q4 in terms of slower Azure growth, which is their main cloud platform.
So, Matt, is it really Google? Is it the big one because it gives us more of an indication of future earnings performance for all tech stocks?
Yeah, I think so. Yeah, to a degree, because I mean they're clearly one of the bellwethers along with Meta for the advertising market, and I think clearly if corporates are spending less on advertising, it tells you that they're tightening their belts generally. So I think that was a kind of really important signal that we are finally starting to see signs of the economic slowdown hitting corporates at large, and beyond that, obviously that they have a growing cloud business. It's still growing well, but it's not making money yet. And so I think there's perhaps some frustration there that, how big does this thing have to get before it makes some money? It's generating $7 billion, also maybe more of a kind of revenue a quarter. It's kind of, a big business. And also YouTube was slower. And I think that points to the structural pressures in the ad market with TikTok coming in and really pressuring the established players in that marketplace.
So they're all trying to rival TikTok.
Rival it and kind of catch up on it, kind of replicate what TikTok's doing to their own businesses.
Yeah, that doesn't really work, right? Unless you have the younger crowd.
No, it doesn't. Yeah, I can think TikTok's got such a strong lead. Obviously, the other area that they're trying to kind of tap into with YouTube is the whole connected TV push. And I think people are expecting to see some better traction there. But with clients cutting budgets, there's less money to go around.
Talk to me a little bit about Elon Musk and Twitter. So he thinks that by this Friday, he's got it. And then there was all this rumor about cutting 75% of the workforce.
Yeah, that's right. So obviously, first of all, is the deal going to happen by Friday? It's kind of certainly leaning more that way, and the bid spread has narrowed. He had a call apparently yesterday with his bankers to line up the debt, so that's really important. I think the headcount cuts. I mean, I think Alex Webb was talking about this last week, and when he was in San Fran a month or two ago, definitely the word on the street was that Twitter can easily cope with 60 or 70% less heads. So I think certainly if Elon does do the deal, he's going to kind of significantly reimagine what Twitter is as a business.
Matt, thank you so much. As always, Matt Bloxham there, looking at tech from Bloomberg Intelligence. Coming up, earnings season, full swing. In case you hadn't noticed, major European banks reported today. So we'll discuss how things are looking with Mike Scott. He's lead portfolio manager for high yield and credit opportunities at Man Group. This is Bloomberg. Bank earnings in the spotlight. Deutsche Bank and UniCredit lift their revenue outlooks as higher rates boost trading. For Barclays, it's a miss. Big tech battered Microsoft, Alphabet, and Texas Instruments tumble after hours as weak earnings hit some of the world's top companies. Plus, the new Prime Minister, Rishi Sunak, appoints his cabinet as the Times reports he may delay next week's fiscal statement. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So earnings season picking up pace with inflation looming over quarterly results. Let's discuss all of this with Mike Scott. He is lead portfolio manager for high yield and credit opportunities at Man Group. It's, of course, the world's largest publicly traded hedge fund firm. So, Michael, thank you so much for joining us. Now, first of all, when you look at banks in general, so this is your specialty, right? You do high credit. When you look at the sustainability of some of this credit in banks overall, are we in a better place than we were 10 years ago?
I would say we're certainly in a better place from a credit perspective. Clearly, post the GFC, banks have really gone through a cleansing and from improving the balance sheet metrics from solvency, etc. So, from a credit perspective, we're actually less concerned about the banking system going into what we see as a global downturn. But nonetheless, we do think that earnings will likely become pressured as we go into 23 from rising provisions.
I mean, 3 weeks ago, it's pretty scary what happened on the gilt market. And we were hearing about some huge margin calls with some operators also potentially going bust if the Bank of England hadn't intervened.
Well, I think that was a very interesting period. And I don't think it was necessarily just solely a UK problem. I think what it does highlight is the hidden leverage that exists within the financial system, not least just in the banking system, but also in the shadow banking system. I think we've seen numbers where our total assets in the pension industry in the UK are 500 billion, but actually there's 1.5 trillion of invested assets. And clearly from these derivative contracts, when there was a significant margin calls from the rising gilt yields, it's had a very clear impact and devastating impact for some of these pensions.
But Mike, so as we go into QT, I mean, this is an extremely uncertain time because you see parts of the markets, part of the banking, and we mentioned shadow banking during the break, where people have been swimming naked, right? Which is not the same business if your leverage is 1%, if suddenly interest rates go to 5%. Where do you see the fault lines?
Absolutely. So from a credit perspective, so we work in some investment grade and certainly is always at the bleeding edge, I would say, of a downturn and a rising interest rate environment. We certainly see defaults picking up. And I think what is interesting actually about this cycle is actually from a high yield perspective, high yield bond market perspective, companies are coming into this from actually a position of strength. They have spent the last 2 years terming out their debt, which has actually meant that default pressures we think could be, will certainly increase, but certainly won't be comparable to what we saw in the GFC.
But this is what, 20% of possible defaults, or is that too high?
I think that's very high. I think in a bearish case, we could see high single digit. I think in our base case, we're likely to see mid single digit. But nonetheless, we are coming from very low levels currently. And as we go into a broader global downturn, that is very much going to be a feature of 2023.
I mean, how difficult at this point is it to see, the banks that are in more of a precarious situation than others? Again, I mean, we didn't see any margin calls, for example, on some of the big commodity players or hedge funds that maybe were expecting at the time of the invasion of Ukraine. But then you could have a whole other set of problems.
So I think for me, a financial side of things, as I say, from a credit perspective, we do see the banking sector in a much better state than it was 10 years ago. So from where we do have concerns, however, in credit markets is very much more in the loan space.
Right.
So where companies...
Mortgages?
So as in leverage loans.
Okay.
So these are a close cousin, I would say, to the high yield bond market. And many of these businesses are unhedged from an interest rates perspective. Just to give you a stats, 30% of businesses in the leverage loan market in Europe are hedged for interest rate rises. So that's 70% of the market is unhedged. And that was before going into a more difficult demand backdrop. So we do see default rates being actually more problematic in the leverage loan market than we do in the high yield bond market.
And this is what, for the UK, or is there a difference between UK and Europe, or do they have very similar patterns?
They have quite similar patterns insofar as both economies, or major economies, have felt a very strong terms of trade shock. And that has been driven by the energy crisis, and as you say, the war in Ukraine has been a big driver of that. I would say that from a European and UK perspective, the market is already pricing in to some degree quite a dire backdrop for 2023. I think we see actually moving over to the US, that's not the case. Right. So actually the US market still needs to price in what we expect to be a recessionary type backdrop for the US as well in 2023. So
Mike, when you look at your charts and when you look at some of the high yield credit, where do you see the signals of distress coming?
I think they have been building already, and the initial sectors to really to show credit distress already have been primarily very affected by interest rate rises. So the property sector, for instance, consumer durables, etc. But I think as we look into 2023, this is certainly going to morph into more traditional cyclicals in the way of industrials, cap goods, basics, automotive OEMs, and suppliers. But as I say, I do think that from our perspective, whilst default rates are going to certainly increase in the high yield bond market, they may not be as we don't expect them to be as severe as they were in the prior recessionary backdrop.
Mike, what's your highest conviction call?
So our highest conviction call currently, and where we're paid for the risk that we take, we think non-cyclical cash-generative businesses with very strong pricing power. So we like areas of healthcare, we like areas of consumer staples in particular. Often these businesses have very strong asset backing as well. So from a creditor perspective, we not only get fairly resilient cash flows, but we also get security from the assets that back those credits as well.
Mike, thank you so much for coming on TV today. Mike Scott, their lead portfolio manager for high yield and credit opportunities at Man GLG. Now, coming up, we'll recap what we've heard so far from European bank earnings. We also look at market reaction. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, returning to one of the biggest stories this morning, Deutsche Bank says it may exceed its full-year revenue target after beating a third-quarter earnings estimate. The chief financial officer, James Moltke, spoke to Danny Berger a short time ago about those strong earnings.
what we're focused on is having a portfolio of businesses that can sort of create some earnings stability throughout the cycle. And you're seeing that now with very strong FICC and relatively weak or very weak origination advisory. I think that will sort of change again, or there'll be a rotation in 2023 as volatility begins to stabilize. You know, the markets now, I think, have a clearer view of terminal rates for interest. I think there'll be a settling once we have visibility into the path of both interest rates and the economy.
So as that deal flow then comes back 2023?
And I think at that point the deal flow begins to come back. In a sense, macro shifting back to micro at a point in time, at which point origination advisory and for example, the credit business within FICC markets would likely start to come back.
When do you see that happening? When in 2023?
If I had to guess, it'd be the second half of next year. So I think there's still some time to go on this more volatile environment. As you say, it's important as well that the businesses that we have that have large deposit books and who are based on growing loans, so corporate bank and private bank, they're now seeing real momentum, benefiting from interest rates, but also client activity.
But when it comes to those riskier loans, the leverage loans, is now the time, until the environment normalizes, to get low to the ground, to cut back on risk?
Well, look, our commitment pipeline at this point is down to only about $2 billion, and we think we've marked that now appropriately to the current conditions. It's a feature of the leveraged debt capital markets that there'll be a backup every once in a while when financial market conditions change. The banks work through their pipelines, and then as investors and also issuers find sort of a more accommodative environment and more predictability in terms of pricing, the market reopens. And you're beginning to see that already in the third quarter.
Deutsche Bank Chief Financial Officer James von Moltke speaking there to our own Danny Berger. Well, Danny's in Frankfurt for us. So, Danny, great interview. Can you walk us through some of the numbers from Deutsche Bank?
Yeah, Deutsche Bank's story really is one that reflects the entirety of the banking sector we've seen so far this year. So the volatility means that trading numbers were strong. FICC revenue, that was really strong, easily beating most of Wall Street. Interest rates, those also giving them a lift. Net interest income was higher as well. But similarly, like the rest of the banking sector, advisory and origination was very weak, perhaps weaker at Deutsche Bank than a lot of other banks. Of course, that business is a bit smaller than we see elsewhere, but that fell 85%. You heard in that interview there, he does think that it will come back in the third quarter, or rather by mid next year. But still is painful and costs are higher. So those two combined might be part of the reason we're seeing some of the weakness in shares this morning.
So the business may still be strong, Danny. Deutsche Bank also operating in a difficult economy. What did he tell you about that?
Yeah, he sees a 2% recession in Germany next year, but it's not just that. It is a permanent shift that Germany is going to have to go through. It is, he called it, a deep restructuring that will last many years. It's changing energy policy. It's changing trade with China. It's changing exports. And then there are also risks. He doesn't see them in the banking system, but he does see them spread out through these financial markets that regulators perhaps have less leverage over. He talked to me about that. Take a listen.
The market is uncertain how much of the risks and where has gone into the non-bank sector, the less regulated sectors, and so is there sort of there going to be shoes to drop in that area? That's probably the greatest degree of focus, and then also what we sometimes call cross-asset risk. So ways in which asset markets talk to each other that models sometimes don't predict. Those are two areas that we're looking for and looking out for potential risks and surprises.
Yep. So, Danny, Deutsche Bank CFO, they're also telling you some advice, I love this so much, for Credit Suisse. I'm sure they loved it.
Yeah, and look, it felt right to ask Francine because, of course, it's the biggest story in banking at the moment, but also Deutsche Bank more than 3 years ago had to go through the same process of doing a restructuring, a large one, in order to get that investor confidence back. Von Moltke said it came down to being decisive, to having discipline execution. And so I said, okay, give me exactly what is your advice to your peer going through something similar? He said, they've got to be patient. They need to have their eye on literally every detail. And you have to bring your people along. Of course, Francine, that people question, retaining talent, we know that's been a bit of a stick in the mud for Credit Suisse.
Yeah, so difficult as people leave the firm. Thank you so much. Our Danny Berger there, great interview with the Chief Financial Officer of Deutsche Bank. Now, as we've been hearing, a big week for earnings banks. Well, bank earnings. Santander, Barclays also reporting. We also had UniCredit. So let's get our resident expert from Bloomberg Intelligence on the banks. He is Jonathan Tice. Jonathan, great to have you today to really try and unpack like the millions, I mean, maybe not millions, but the dozens of banks we're getting this week. Who's strongest?
Well, I mean, we've seen very good revenue across the board. I think if you look at share price reactions, for example, yesterday HSBC a little bit harsh. CFO did leave, but a very strong set of numbers. Look at Santander today, a very comfortable beat on revenue, but a small cost miss. So when you say who's strongest, everybody's getting the uplift from net interest income. One thing is key, you've got to do a really good job on costs, because the market is looking through the net interest income uplift at the moment. They're looking at what management are doing with costs. They're also looking at guidance on bad debt and provisioning. And again, HSBC was a little ahead of consensus there.
But are you surprised that we haven't seen a bit, distress in that yet? So either loans, but also mortgages, or does that come early next year?
It's too early to see it in the numbers, but because of IFRS 9, which is the way they can account for it, we're going to begin to see banks taking charges ahead of time. They can do things like management overlays, post-model adjustments. This quarter and a lot more next quarter, we're expecting to see banks build the buffers, because also you lower your ROE. You don't want the regulators and the Bank of England and the ECB looking at revenues and saying, hang on a sec, you guys are making 15% ROE just because rates are going up, here comes a new windfall tax. So provisioning will be used as well, I think, by the banks to try and stave off measures from regulators.
So are you expecting a lot more of those provisions to be, I mean, when does it hit? And is it more UK banks compared to European banks?
I think probably more UK at the moment. And I think Lloyds and Barclays today, Lloyds and NatWest will be talking about this. The bigger banks, BNP, for example, has a very sensible policy. They kind of smooth it anyway, so we won't see any negative surprises there. It's the Santanders of this world with the big EM businesses. That's where if you do get a move, they move very, very quickly.
What did you make of Barclays?
Decent numbers. They're doing well on costs. FIC was decent. I think all in all, they're doing a very good job. But as ever with wholesale funded banks, the market doesn't really care, and they look through the trading. I mean, FIC, 63% growth in dollars was huge, and they're a dollar beneficiary. You look at HSBC yesterday, the dollar has hurt them quite badly because of their UK cost base. So doing well, but as ever, the market sort of looks through it.
So what does the market want to know? Like the business model longer term, right? Which sometimes gets muddled in the earnings quarterly results.
Yeah, I mean, sustainability, as the CFO of Deutsche said, the question we have is how quickly does FIC stabilise? Equities isn't doing great, and fees, Deutsche was of the biggest fall, but they've fallen off a cliff. Remember last year it was massive fees, terrible FIC and OK equities. I think FIC will continue to do well through into early next year. How quickly does fees bounce back, and how brutal will they be on costs? Because it is the fee pool from the investment bank that pays the bonuses.
Talking about brutal, what do you do with Credit Suisse?
Well, it will be interesting. I mean, it's all about how many disposals they make. Because if they don't manage to sell enough at the right price, they do need a capital raise. Clearly that's dilutive. They don't want the regulator to step in and say, you need a capital raise. So it's about the disposals for them.
Is there really talk, and I hear this, and I kind of, a lot of times push back, it's not a solvency problem. I mean, is it a problem? We're not talking about this bank going under.
No. But remember, though, that what we learned in 2008-09, it's not about capital, it's about liquidity. And as and when clients stop, interbank market closes, we start worrying about these things. So, no, it isn't solvency, but they do need to shore up capital.
Jonathan, thank you so much. As always, Jonathan Tice there on the banks from Bloomberg Intelligence. Now, coming up, we'll take a look at what is driving the markets today. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Zara parent company Inditex has agreed to sell its business in Russia to the Middle Eastern Daher Group. The deal will preserve a substantial number of jobs in Russia, with the company picking up most of the store rental contracts. In June, Inditex, the world's biggest clothing retailer, said it was taking a €260 million provision for shutting operations in Russia and in Ukraine. General Motors beat Wall Street's consensus third-quarter profit estimates on record revenue, adjusted profit of $2.25 a share, surpassing analysts' projection of $1.89. GM also maintained its full-year profit thanks to strong sales of its luxury Cadillac SUVs and largest trucks.
We're seeing still very strong demand for our products. We're seeing strong average transaction pricing that we continue to be able to build on. And so, we are starting to see inventory build just a little bit, but well below levels that were in the past. So overall, we're still seeing a very strong consumer for our products.
And Adidas intends to sell existing Yeezy product designs using its own branding after ending its partnership with the rapper and designer Ye, formerly known as Kanye West. The company expects a €250 million hit to earnings after terminating its relationship with the star over a string of controversial social media comments. Intel's self-driving technology company Mobileye has raised $861 million in one of the biggest US IPOs of the year. Shares priced above the marketed range. At the IPO price, the company has a market value of more than $16 billion. Intel will still control Mobileye. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's get more on what's moving markets in the second hour of equity trading with Bloomberg's Joe Easton. Joe, thank you for joining us. We look at the banks, we look at technology.
Yeah, so obviously a big earnings day, as you mentioned, the banks taking a lot of focus. Obviously some individual stories going on there with Deutsche Bank, Santander as well. But they're all really facing the same kind of dynamics at the moment. Higher central bank rates is by far the most important thing for any bank at the moment. It's really a big kind of payday for them. But obviously the downside is the potential for a slowdown in loans, particularly in the UK with the mortgage market crisis, consumer credit cards, that kind of thing. So it's kind of a strange situation where banks are getting a big boost at the moment from the rising rates, but are also very wary that they could see a drop down in their loans coming through.
Joe, what do we do with technology?
So
it wasn't great.
No, it's. I think it's looking pretty scary, actually. Some of the numbers that you're seeing, some of the declines that we've seen in, Google, Microsoft pre-market, not looking great at all. Kind of makes sense, given that they're so entrenched in the global economy and have so many suppliers and other businesses that are dependent on them. But then you have to think, how much further can these stocks go? And if the economy starts to, bottom out into early next year, central banks then have to rethink the policy outlook, and you'd potentially see a lowering of the discount rates, and those stocks could look cheap again. So I think there's obviously a lot going on.
And then, Joe, tomorrow, ECB. So this is a big one. And then we had actually the new Italian Prime Minister going after the ECB in her first speech yesterday.
Yep, so ECB tomorrow, obviously most people looking for a 75 basis point hike, but I think there's a lot of division in the central bank there. You mentioned Italy. If you're Italy, do you really want to start hiking rates really aggressively at the moment? I don't think so. The same with Spain. Germany, yes. So there's some division. And with the euro, the cheap level where the euro is, that will start importing inflation more into the eurozone as the end of the year comes in. And I think that could even put more pressure on some of the more hawkish members to hike. But the other periphery members will be less keen to do so.
OK, you have stocks to watch, or you were looking at stocks, and we're cleaning our houses less.
Yeah, that's coming from Reckitt in the UK. So Reckitt obviously make Lysol, a couple of other big brands, but they say that the hygiene business is dropping. Sales aren't as good as expected. We're all not cleaning as much as we were during the pandemic. We didn't have much else to do. We were all cleaning, and now we're not doing so much of that.
Oh, come on, Joe. People, clean your houses. This is like our word of advice for Wednesday, right? I mean, I should start cleaning my house more.
Yeah, Reckitt will want you to do so.
Yeah, guilty as charged. Joe, thank you so much. Joe Easton there with the stocks to watch as well. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Kailey Leinz in New York, or Anna Edwards here in London, and this is Bloomberg.
the risk of a US recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%.
On the persistence, the high level and persistence of inflation, the rate environment, and now with a recession call both in the US and Europe, the recession, we believe, will be in and around 2% next year in GDP terms relative to 22.
We're prepared to a more extreme scenario, which would see a recession on average at more than 3% next year.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Tech's big day turns into a bust. Microsoft, Alphabet, and Texas Instruments all come out with disappointing results. Deutsche Bank delivers. Fixed income trading revenue soars while rising interest rates boost income from lending. And it's Rishi Sunak's first full day in office. Will his government stick to the date for next week's fiscal statement? A cabinet official suggests it could be delayed. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. And Kailey, it seems we're all suffering a little bit of a tech hangover, certainly if you look at European markets and US futures. But before that, we still had some positivity in Asia.
Yeah, Asia didn't really feel that downward drag from the disappointing U.S. tech earnings of after the bell yesterday. In fact, we saw a continued recovery from what was brutal selling on Monday. Of course, that recovery started in the Tuesday session and it continued on this Wednesday. Overall, the MSCI Asia Pacific Index higher by about 1.3% on the day, with Chinese stocks up about 0.8%. One thing boosting sentiment is a vow from the PBOC and China's Foreign Exchange Authority saying that they will support the development of stock and bond markets and the Chinese yuan will remain, quote, relatively stable. And on the subject of the yuan, the offshore yuan strengthening against the U.S. dollar, coming off of record lows, actually stronger by 1.75% on the day. So really big move. We're now back down at the 718.58 level or so. So definitely something to watch. Although keep in mind that literally everything in Asia and G10 is weaker, or stronger rather, against a weaker U.S. dollar on the day. And of course, in the bond market, we have seen some real buying coming in, yields moving sharply lower, a move that started with the Treasury market yesterday, but that continued overnight. In Australia, for example, the 10-year yield down nearly 16 basis points on the day to just shy of 392, Kriti.
Yeah, Kailey, that tech hangover that maybe escaped Asia definitely has not escaped the United States. What I will say, though, is some of the gains or some of the losses that you did see earlier in the session, well, some of those have been paired. Check it out. The S&P 500 futures only down 0.5%. Earlier in the session, you did actually see them lower by almost 1%. So perhaps a little bit of readjustment post those tech earnings. Take a look at the 10-year yield, though, because as you pointed out, the bond market is catching a bit around the world, it seems. 404 on the 10-year yield, down about 6 basis points, but in a volatility kind of induced context, it's still not as big of this move that we've been seeing. Remember, moves of 15, 20 basis points in one day. Do we see that again today, perhaps as maybe a little bit panic on the macro sphere? Speaking of, as we see those yields come lower, the dollar follows not too far behind, down about 0.9%. What's interesting, though, is that even with the weaker dollar, you're not seeing a massive move higher in commodities. In fact, Brent crude only up about 0.2%, trading with a 93 handle, Anna. Whether that continues remains to be seen.
Yeah, we've seen quite a bit of volatility, actually, in that oil price just this morning, Kriti. Let's have a look at the European picture, and it looks pretty mixed, actually, and we're caught between a number of different narratives here. We've got the positivity, perhaps, coming from a lower, at the margin, very recent lower yield environment. That seems to be the most recent developing story attached to weaker data out of the US. That might leave room for risk assets to rally. But on the other hand, the tech story is not positive, and we've got a mixed picture for earnings here in Europe as well, with recession fears on the horizon. So all of that playing into a mixed story for Europe. Here's a few of the businesses reporting today that I picked out to talk about. Santander, the Spanish bank, down by 3.4%. On the map, you can see that Spain was weak, and partly it's to do with Santander. They actually delivered numbers that showed that, just like many of the other banks in Europe, they're in a bit of a sweet spot where the net interest margin is getting a boost from the higher rates environment, and we haven't really seen too many questions about asset quality deterioration just yet, although there's a fear that's coming. Costs a bit of an issue at Santander, according to some of the analysts. UniCredit, this stock up by 4%, showing some of the same dynamics I described describe in terms of the banking sector and net interest margins, and also pleasing the market, it would seem, with some of the guidance that they've renewed and improved for another quarter. Heineken is down by 10% today. This is a beer maker, of course, and their trading volumes, the amount of beer they sold actually went up, but not as much as had been anticipated, and cost, once again, an issue over at Heineken. Here's the pound, and here we are seeing a little bit of response to what's going on in fixed income and a reassessment, perhaps, or a reevaluation of just how much hiking we get from the Federal Reserve and other central banks. So the pound at 116 right now, up by more than 1%. So real recovery we're seeing here in the pound, but it is a dollar weakness story, and it is because at the margin, investors, Kailey, increasingly questioning just how much hiking and for how long we're going to get from the Federal Reserve as we see that data in the US deteriorate.
Yep, which is why the dollar is so much weaker on the day, and we are seeing a bid coming into the bond market. We will keep on top of those cross-asset moves, but first we want to zero in on tech stocks, which, as we said, are dragging on risk sentiment this morning. In pre-market trading, you have Microsoft and Alphabet each down in the ballpark of 6% after disappointing results. For Microsoft, it posted its weakest quarterly sales growth in 5 years. Alphabet sales fell short of expectations as well. Alex Webb of Bloomberg Quick Take is joining us now for more. So, Alex, sentiment wasn't overly bullish going into these results, and yet somehow the bar was still too high. What does this tell us?
Well, yes, as you say quite rightly, I think the bar was quite low, and anything that suggested even the slightest glimmer of upside was likely to have been taken well. There was very little upside. It probably oughtn't to have been a surprise. We knew that a lot of the spending when it came to cloud computing, when it came to hardware, had been brought forward by the lockdowns as companies worked out how their employees were going to work from home. But we also saw then that the impact of inflation on consumer spending has therefore affected companies' ability to advertise, and so that has a massively detrimental effect on Google, which is the single biggest advertising technology company in the world. We'd seen an impact on the smaller guys. The fact that it is now hitting Google as well is significant.
But then we also have it hitting the business investment side as well with Microsoft. Talk to us a little bit about the impact, or at least the read-through in some of those Asia numbers.
Yeah, so Azure is, we should qualify this by saying that it's the outlook for Azure, which is Microsoft's cloud computing business, that has really roiled the market a little bit, with obviously Microsoft now appearing to trade down. But the commentary was that growth will be 5% slower than in the previous quarter. So if you read through those numbers, it still implies 37% growth compared to the 42%. So it is still a growing business. It's just clearly not as fast as it used to be. And as I was saying before, it is likely because people front-loaded a lot of their spending, their onboarding onto that platform during the lockdowns. There isn't that much more new spending as a consequence.
Alex, finally, we see a ripple effect from Alphabet's results in the weak advertising trends there through other ad-sensitive stocks like Meta, for example. It's not touching Twitter, though. Twitter is actually higher by about 0.4%, $53 a share. That has everything to do with Elon Musk saying he plans to close the deal by Friday. What's the likelihood that really happens?
Well, it's a lot of the reporting that our colleagues have made suggests that bankers are working very hard to do so. The only obvious fly in the ointment would appear to be some regulatory pushback. It seems as though that maybe the Biden administration is having a look at the deal in the context of some of the comments that Elon Musk has made pertaining to the war in Ukraine. But we haven't yet had anything official on that nature. So as things stand, as implied by the stock price, there is a lot of confidence in this deal happening by the end of the week. Again, I will qualify that by saying the stock has never traded in line with the $54.20. So there's always a little bit of wiggle room.
A little bit of execution risk still in that price then. Alex, thanks so much. Alex Webb of Bloomberg Quick Take with the latest on the news flow coming through thick and fast from the tech sector. More on that later. It's also a busy week for European bank earnings. Deutsche Bank says it may exceed its full-year revenue target after beating third quarter earnings estimates. But the CFO, James van Moltke, is still looking for potential risks in the current macro backdrop. He spoke with Bloomberg's Danny Berger earlier.
The market is uncertain how much of the risks and where has gone into the non-bank sector, the less regulated sectors, and so is there sort of there going to be shoes to drop in that area? That's probably the greatest degree of focus, and then also what we sometimes call cross-asset risk. So ways in which asset markets talk to each other that models sometimes don't predict. those are two areas that we're looking for and looking out for potential risks and surprises.
Yep. James Van Moltke there. Bloomberg's Danny Berger joins us now from Frankfurt with more. Danny, trading comes in strong. Deals, though, are bad and bad across the sector. Where does Deutsche Bank go from here?
Well, Deutsche Bank Von Moltke specifically, when I asked him about that business mix, he did think it would normalize. He said, look, deal flow, deal activity, for us, that's going to come back. For the markets, it's going to come back by the second half of next year, once interest rates normalize, or at least we get a grip on that environment. But in the meantime, this was their worst quarter for deals and origination since the financial crisis, dropping 85% year over year. Now, to be clear, FICC was really strong. Net interest income gave them a boost as well, thanks to higher rates. So overall, their earnings net revenue looks strong. But yes, that is definitely a problem for them. And also a problem was higher than expected costs, rather. Obviously, higher earnings is not a problem, but higher than expected costs was a problem. And that's potentially why we see shares lower today.
On the subject of problems, other banks have their fair share of them, including Credit Suisse. And James Van Moltke also had some advice to Credit Suisse for their restructuring. What was his message?
Yeah, Kailey, you know I had to ask this because look, at the end of the day, Deutsche Bank went through the same thing. More than 3 years ago, they started their mass restructuring, trying to get investor confidence back, and by most measures, if not all, they have. So he said, look, the key to that success, it's about being very decisive, taking action, sticking to it. And then I said, okay, then what's your advice to Credit Suisse specifically? And he said for them that they need to be patient, very, very focused on literally every detail, and they need to bring their people along. Of course, we know talent retainment at Credit Suisse, that certainly has been an issue for them.
Danny, thanks so much. Bloomberg's Danny Berger from Frankfurt with the latest on the Deutsche Bank story. Let's get to UK politics. UK Prime Minister Rishi Sunak named an experienced cabinet to lead the UK through what he called a profound economic crisis. He confirmed that Jeremy Hunt will remain Chancellor of the Exchequer, but according to Foreign Secretary James Cleverly, Sunak may delay an economic plan scheduled for next week and watched closely by the markets. Bloomberg's Lizzie Burden joins us now from Westminster. Lizzie, what do we know then about the October 31st date that we have marked in our diaries, marked in our calendars as important for a fiscal statement in the UK?
Well, Rishi Sunak's been meeting his new cabinet for the first time this morning, including the returned Chancellor, Jeremy Hunt. So we'll be expecting confirmation later today. James Cleverly, of course, the Foreign Secretary, hinting at a delay. And of course, it wouldn't be surprising if Rishi Sunak wanted to delay this because it's going to be a premiership-defining fiscal statement. Jeremy Hunt has said himself he's going to have to take eye-wateringly difficult decisions, although Hunt has hinted that he personally wouldn't want to delay the fiscal statement so that the Bank of England can take account of it and so that potentially there could be a smaller rate hike from the Bank of England this time. The good news, though, is that former BOE and OBR official Charlie Bean has said that the fiscal black hole that Jeremy Hunt's going to have to shrink is now smaller. It's now £30 billion rather than £40 billion by his estimation because of Rishi Sunak's effect on calming the markets.
Well, Rishi Sunak has also appeared to have kept his friends fairly close, his enemies even closer when it comes to his cabinet appointments. What does that say about his administration?
Well, it's been a firm nod to party unity. He's kept the three holders of the great offices of state in the same positions they were last week. A bit of a change in the middle for Suella Braverman, the Home Secretary, but she is the most controversial reappointment because she was sacked only 6 days ago for breaching the ministerial code. Yesterday, Rishi Sunak was professing to be bringing back integrity to Number 10, and yet Braverman is back, and it seems to have been because of the deals Sunak had to make with the Tory right to get into Number 10. So you can expect Keir Starmer, the opposition leader, to raise that point at Prime Minister's questions in his first face-off as Prime Minister with Rishi Sunak later. But it's also meant that Sunak's key allies have had to have rewards lower down the pecking order. So, for example, Mel Stride, his chief campaign officer, becomes Work and Pension Finance Secretary, although that is an important role at this moment, given the debate over whether benefits should rise in line with inflation. He thinks they should. But it also means that Penny Mordaunt hasn't had a promotion. She didn't look very happy coming out of number 10 yesterday, but perhaps that's her punishment for only conceding to Rishi Sunak at the very last minute. But really, the need for party unity has meant that Rishi Sunak, as you say, has had to keep his enemies closer than perhaps he'd have liked to.
All right, Bloomberg's Lizzie Burden, thank you so much for your terrific reporting from Westminster. Let's get back to some of the earnings stories we need to pay attention to this morning, though, and take a look at some stocks moving in pre-market trading here in the U.S. One of the disappointing tech results out after the bell yesterday, in addition to the big guys, Microsoft and Alphabet, was Texas Instrument. This company makes chips for everything from home appliances to missiles, and its quarterly forecast came up short of expectations. So that suggests that the chip slump is expanding beyond just smartphones and computing. As a result, that stock is down about 4.6% before the bell. It is also a downward move for Spotify after its results. It said profit margins may narrow because of higher programming costs, and as a result, it may need to raise prices here in the U.S. Interestingly, the company also talked about a slowdown in ad spending, so that echoes what we heard from Google overnight as well. Spotify down about 4.9%, and it's an even bigger plunge for Skechers, the shoemaking company that sells a bunch of sneakers. It missed expectations for its forecast on both the top and bottom line, and as a result, that stock is down 13.5% before the bell, Anna.
Okay, coming up on the program then, Kailey, we will be in Riyadh. The Future Investment Institute event is taking place in Riyadh in Saudi Arabia. An exclusive conversation will bring that to you with Saudi Arabia's Minister of Finance. Plus, the world's biggest source of clean energy is evaporating fast. Read more of today's big take story all about hydropower's climate nightmare on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg's early edition. I'm Kriti Gupta alongside Anna Edwards and Kailey Leinz in New York. Matt Miller is off today. I really want to dive in here with a terminal chart that really caught my eye about housing prices. This is enormous because this actually moved the market yesterday through the bond market, ripple effect into the stock market. For our radio audience, stick with me. Basically, we're looking at S&P CoreLogic Case-Shiller data from 20 cities. The housing prices around some of these major countries actually dropping quite a bit, the most, by the way, since 2009. At the same time, you see mortgage rates really rising quite quickly. The effect of the Federal Reserve and those massive hikes perhaps now actually having a more tangible effect on a housing market that's considered to be extremely tight, perhaps booming a little too fast. That slack in the housing market perhaps helping the case for a little bit of a Fed pivot. Once again, yesterday it fed into the bond market, which then in turn fed into the stock market. I want to bring in Ksenia Galushko, the Bloomberg Equities team leader, to hop in on this conversation because, Ksenia, to me, this feels like an early sign that perhaps equities do have a reason to rally if they see perhaps a less hawkish stance from the Federal Reserve. Do you agree?
That's right, yes. So housing prices are starting to finally calm down, and also consumer confidence is plunging in the U.S. And this is good news for inflation and the Fed's fight to lower it, obviously. So yes, perhaps the stock market can start pricing in a potential pivot, but I think the Fed's comments so far have been very hawkish. They are reiterating that they're going to keep raising rates. They're going to stay hawkish for a while until they really see inflation peaking and starting to fall. And it might still take a couple of months or even a couple of quarters.
And Ksenia, that's really interesting then, isn't it? Because this potentially opens up a really big question and a really big opportunity, and the market's been wrong-footed by the thought of pivoting before, and it's very mindful of that. Where do we see the bottom as now for stocks? Because I know Goldman Sachs thinks we're not there yet.
Well, yes, so it depends on who you listen to. So Goldman Sachs indeed says that the U.S. stock market, despite the plunge that we've seen this year, has not priced in recession risks and a possible escalation in the Ukraine war or other geopolitical fears. But it seems like it's their worst-case scenario. So they do say that there's potentially 20 or 30% downside for the S&P 500 if the U.S. recession does come through. But at the same time, we've got Morgan Stanley's Michael Wilson saying that actually he forecasts a 15% bounce for the S&P 500 because because it has bounced off that very important technical level of the 200-week moving average. So we could see upside from here.
Okay. Yeah, is it still a bear market bounce or is it something more material? Ksenia, thank you very much. European stocks very much in limbo today. Ksenia Galuchko joining us there with the latest on the markets. And for more insight and analysis into the markets, MLive Go is the function to use on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. President Biden congratulated new British Prime Minister Rishi Sunak in a phone call yesterday. The two discussed the Russian invasion of Ukraine and challenges arising from China. The two also talked about the unresolved issue of the Irish border after Brexit. Last month's pickup in Chinese business activity wasn't enough to change the country's grim economic picture. The economy slowed in October as car and real estate sales weakened. Meanwhile, China's global trade and small business confidence contracted. All this according to Bloomberg's aggregate index of 8 early indicators. The European Union's executive arm will lay out plans to drastically cut pollution levels across the bloc today. That could potentially eliminate more than 70% of the 300,000 premature deaths annually over the next decade. Overhauling air pollution will bring the EU closer to guidelines laid out by the World Health Organization. And New York is still the most expensive rental market in the U.S., but Boston has now passed San Francisco for second place on the list. According to listing company Zumper, the median one-bedroom rent in New York is now $3,860. Boston rose almost 6% this month to $3,060, while San Francisco is $40 less. Coming up, we will go live to the Future Investment Institute event in Riyadh with an exclusive conversation with the Saudi Arabia Minister of Finance. That conversation is coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Tech's big day turns into a bust. Microsoft, Alphabet and Texas Instruments all come out with disappointing results. Deutsche Bank delivers. Fixed income trading revenue soars while rising interest rates boost income from lending. And it's Rishi Sunak's first full day in office. Will his government stick to the date for next week's fiscal statement? A cabinet official suggests it could be delayed. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. In fact, not Matt Miller, apologies. Kriti Gupta with us. Matt is off today. And Kriti, what do you see in the US futures picture? Because tech has dominated overnight, a sell-off in all things big tech as a result of some disappointing sales numbers.
Yeah, exactly. No worries, Anna. The resemblance is uncanny with me and Matt Miller. But to your point on futures,
like
that's
he
really
was in the room.
Absolutely. He's still here in spirit. The truth about futures, though, is exactly what you said. You do have this macroeconomic fear that what Alphabet and what Microsoft is actually kind of indicating is the slowdown in a recession. Essentially what the market is perhaps pricing in for about a year now, but also put this into some perspective from a technical level. You have had 2 days of gains that have been pretty fast and furious on the S&P 500. Some idea here that perhaps is the start of some sort of sustainable bull market rally, at least for those who are long on the equity market. Today, not so much. So a little bit of a pullback. Even in just the last 30 minutes, you've seen futures go from negative about 0.5%, now lower by about 0.8%. And it's not alone. The bond market also catching a bid here because you are seeing 10-year yield drop as well, about 4 basis points, 4.06 on the 10-year yield. And with those yields lower, the dollar follows. The Bloomberg dollar index down about 0.6%. But even as you see a weakening dollar, not all of it is translating into the commodity space. Remember, there is that inverse correlation given a lot of the commodity contracts are priced in dollars. Nevertheless, Brent crude hovering at about a 93 handle, Kailey.
All right, Kriti, well, let's take a look at some of those moves that are really creating the drag in the broader equity market, and that comes from the mega cap tech companies that gave disappointing results last night, as Anna mentioned. One of them being Microsoft, reporting its slowest sales growth in 5 years, plus its forecast coming up short of expectations. It's being hit by the stronger dollar, although maybe that's not the case today, as well as slumping PC demand. So it is down about 5.9% right now, while Alphabet is down more than 6%. Of course, its advertising business as it relates to Google as well as YouTube being hit by a slowdown in ad spending with the softening macroeconomic environment. When a giant like Google gets hit, that's how you know it's really bad out there. And that is translating into other advertising reliant companies as well. Meta will be reporting after the bell today. Ahead of those results, it's down about 4% in sympathy with Alphabet. What's interesting is that Twitter also is one of those ad sensitive businesses. It is expected to report this morning, but the fundamentals don't really matter for that company because come Friday, Elon Musk says he will have closed his deal and taken the company private. And so that is why Twitter is higher by about 0.5% this morning. 53.03 is where we trade at the moment. So still not quite at that 54.20 deal price. But Anna, clearly the market is raising its expectations that that is ultimately going to go through.
Yeah, you just have to watch the Elon Musk Twitter feed, I suppose, to get the news that matters when it comes to Twitter's stock right now. Kailey, this is what we see for European stocks. The stocks 600 here in Europe, down by 0.2%. We do see some of the tech stocks under pressure as a result of that negativity around US tech. Here's where we're focused, though. The banking sector very much in focus today here for Europe. Santander, the Spanish bank, weighing on the overall Spanish market. This stock down by more than 3% this morning. I spoke to the CFO earlier. He was talking quite positively, actually, about the UK housing market. That's a big area of business for Santander right now. But in terms of the overall company, there are concerns around costs. And so that seemed to dominate thinking, according to analysts, despite the fact that obviously net interest margins have been rising for many of these European banks. That's been the focus for UniCredit, and the market giving it the benefit of the doubt there. 3.6% higher for that stock. There is that dynamic around net interest margins, which is, of course, important. And the company has guided higher for the period ahead. So that also matters. Heineken is down by 10.5%. The drinks maker then giving an update to the market, which showed that, yes, volumes were rising, but not as much as had been expected by analysts. And costs, once again, costs were an issue in the banking sector. Costs an issue if you're making beer, it seems, no matter which sector, costs very much in focus. Now, it is the second day of Saudi Arabia's Future Investments Initiative, which is taking place in Riyadh. The conference convenes business, finance and political leaders. Joining us now from the event is Bloomberg's Yusuf Gamel Eldin, who is joined by a guest. Yusuf.
Hey, Anna. Well, I mean, we've said before that there's a huge turnout at this event. There are probably about 5,000 people this year. We found refuge from the crowds, be able to sit down with the Minister of Finance, Mohammed Al-Jadaan. Thank you for making some time in what is a very hectic schedule. Saudi Arabia is the fastest growing G20 economy at the moment. There's a lot going for Saudi Arabia. The rest of the world looks pretty bleak. What can you do to mitigate the impact of a potential recession in those other parts of the world?
Thank you, Yusuf. It is indeed interesting times. I think the world is facing a lot of challenges, but the world also needs predictability, the world needs stability, and the world needs cooperation. And I can tell you, in Saudi Arabia, we have been planning for years, executing with really dynamic execution program, and we are seeing the results. The results are very positive. Unemployment, the lowest in 20 years. Private sector is really booming. Investment is up, I think, about 16% compared to last year. Consumption is very strong. What you need is a plan, focus on execution, and then you need to deal with crisis. You need to make sure that you mitigate early, you are ahead of the curve, you take steps, as we have done over the last couple of years, to ensure that we are protected from these shocks.
In terms of 2023, the IMF thinks you can pull in, 3.6% in terms of GDP growth. I'm wondering whether that matches up with your thinking at the moment from what you're seeing in the data.
I think what we focus on is not the total GDP. In Saudi Arabia, we have the oil GDP and non-oil GDP. Vision 2030 focuses on non-oil GDP, and non-oil GDP this year is growing at 5.9. We believe that next year and the next few years are going to grow with similar number, 5 and north of 5%.
What about interest rates? Those are going up. Liquidity is being drained from different parts of the world. I look at the SIBOR, which is a Saudi interbank rate. Those are at record highs for the 6 month. The spread to LIBOR has gone wider as well. What are you doing to alleviate some of the liquidity crunch in the system?
I think there is a lot of liquidity coming into the system. There is a lot of liquidity coming from the government. There is a lot of liquidity coming from investment. And obviously we have a very strong central bank that is able to deal with liquidity. I don't think we have really an issue. We have a very strong banking system, and we are providing a lot of support to the private sector. Part of Vision 2030 is to enable the private sector, and we wanted to see the private sector grow. We are seeing that in investment. Look at the market. The market is up when a lot of markets around the world are down year to date. Saudi market is up. So there is a lot of things going on for Saudi and for the Saudi economy, and we will continue to support the private sector growth.
Inflation has been under control. I mean, that's a good thing so far. But at the same time, it could go up a little bit in the new year in 2023. What measures are you looking at to take out some of the heat and cost pressures for consumers? Are you looking at maybe revisiting VAT?
What we have done, I mean, looking just in the past 18, 24 months, we have done a lot of steps to anticipate this. And we saw what is happening now almost a year before. And we decided to put a ceiling to the energy prices locally so that the economy is not impacted by increase in the energy prices. We have provided support to low-income households, and we really done a great job in making sure that we have a contingency plan when it comes to food. So we stocked more, we built more strategic reserves. We are continuing to do the same. As long as you are ahead of the curve and plan well and execute really dynamically, you will get the results that we are getting. The inflation is below 3%. We don't think it will go even higher than that next year.
One of the things that's being talked about a lot, I mean, from what I've been seeing here, is U.S.-Saudi tensions. Now we are waiting for what the U.S. considers a retaliatory move, because what they're seeing is that the Saudis have taken an aggressive step forward with the decision. You know, of course, you can take the other side of that argument, but for the U.S. it's retaliatory. What would you do if an OPEC bill got passed, or is that something you're not even considering at this point?
Let me tell you, I think without speculating what the U.S. is going to do, U.S.-Saudi relationship has been very strong for the last 7-8 decades. And we weathered a lot of circumstances and situations in the past that are very difficult. I think there are a lot of strategic partnerships and relationships and interests between the two countries. We are taking steps to make sure that we stabilize the energy market, and we'll continue to do so. I mean, we have been tested for years and decades and when it comes to energy markets. But we are also focusing in our non-oil sectors, and we wanted to make sure that these are predictable, provide stability, create jobs, investment opportunities, and you are seeing it here in this event. FII is the most successful year so far. Investors are believing in the country, they see the results, and we'll continue to push on. I will not really be distracted by the noise.
Closing question on Saudi Aramco. You're on the board of the company. They're pulling in record profits. Is there any visibility on an increase of dividends?
I mean, that is for Aramco board. And Aramco also has a lot of plans to invest. They are investing in their capacity. They are investing in distribution lines. They are investing in gas. They are investing in downstream. I will not speculate what the board is going to decide in terms of dividends, but it's at the end of the day, we'll have to wait and see what will happen early next year.
Minister, it's always a pleasure. We've been doing this for a very long time together. I think probably close to 10 years. So thank you for making time again. That's the Minister of Finance, Mohammed Al-Jadaan. Anna, back to you.
Yusuf, thanks very much. Bloomberg's Yusuf Gamal El-Din and Mohammed Al-Jadaan there, the Saudi Arabian finance minister. Really interesting conversation about US-Saudi relationships, crucial as they are in the oil sector. We continue to watch that carefully. Coming up on this programme, we'll get back to the tech sector. Big tech takes a big hit. The likes of Google, Microsoft and Texas Instruments falling in pre-market trading after posting disappointing earnings. More on that sector next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Equity Group Investments founder Sam Zell. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Well, U.S. tech stocks are down this morning and taking the broader market down with them after disappointing earnings from some big names. Microsoft posted its weakest quarterly revenue growth in 5 years, while Alphabet's revenue fell short of expectations. Each of those stocks down around 6% in pre-market trading, while Meta and Twitter are on deck to report today. Joining us now for more is Matt Bloxham of Bloomberg Intelligence. So, Matt, let's just start with Alphabet. If Google can't hang in there, what does that mean for everybody else in this environment?
Yeah, I mean, it's definitely a kind of fairly significant warning about, the direction of travel for advertising budgets across big corporates. I think we've seen some similar surveys recently too, pointing to slower spend next year. There are definitely some nuances there, and also you've got some of the advertising agencies reporting today too, WPP. And I think, the likes of Google are definitely suffering from the downturn in, for example, crypto advertising spend. But, I think definitely across the board pressure on ad budgets.
So that's the Alphabet story, and you're sort of broadening it to the ad story more widely. And I know that we've seen that in different advertising agencies around the world. So that was Alphabet. What about Microsoft? We also heard from them overnight.
Yeah, Microsoft, actually, their numbers for the quarter were pretty strong, slightly better than expectations. It was more of what they said about the forward guidance, which was the problem. So Azure, which is their cloud computing business, they were talking about a 5 percentage point slowdown sequentially in growth. Still very strong growth, probably kind of mid-30% year-on-year growth. But, I think some sense there that the investment in technology upgrades is starting to slow, and some of that revenue is usage-based, and that as corporates see lower activity from their customers, that will translate into lower spending with Microsoft on cloud. So still good growth, but just not as good as people were hoping for.
OK, so still a focus on cloud. And what do we know about the strength of the dollar and how that's impacting these businesses then, Matt? Because this was something we talked about last earnings season, and it hasn't got much better.
No, in fact, it's got a bit worse. So I think it was about 5 percentage points of growth headwind for both Microsoft and Google this quarter, and it's about 3 percentage points last quarter. So I think obviously until we lap those pressures next year, it's going to be a problem, unless of course the US dollar strength reverses, which seems unlikely for now. So yeah, it's definitely a problem for those US listed companies.
Well, Matt, what is the next leg of growth then? And when we're talking about cloud, which has really become this fast and furious transition, not just for Microsoft, but for Alphabet as well in their cloud business, and I dare to say even Amazon Web Services, if you start to see this pullback in business investment, what's the next leg of growth for a lot of these big tech companies?
Well, it's a good question, and I think that the next leg of growth is essentially competing more directly with each other. Also, we've seen Apple push more aggressively into advertising. Amazon's doing the same thing. So I think it's more each other looking at their respective dominant businesses and trying to push for a share of that pie.
How much can be blamed on Apple, Matt?
It's definitely a significant factor. I think it's been more of a factor for Facebook and Meta, and obviously they report later today. They've borne the brunt of those changes to ad tracking. A little bit of an impact there for Google, but I think, certainly for Google overnight, it's more about the kind of broader economic slowdown and perhaps some of the structural pressures we're seeing from TikTok coming in as a quick grower in the digital ad space.
And Matt, finally, in the ad space, Twitter would have some sensitivity there as well, but that doesn't really seem to matter right now. All that matters is whether or not Elon Musk does indeed close the deal on Friday, as he says he will. Given the kind of environment we're talking about, assuming he succeeds in taking the company private, what do you think happens next? How does that business need to be altered and run in an environment competitively and economically like this?
Yeah, it's a good question, and I think obviously we've already heard some hints that he's maybe thinking about some significant headcount cuts, so kind of trimming the cost base substantially. He's obviously historically also talked about some kind of subscription model for that business too. So I think, particularly in light of a weaker ad environment, I think there's always been issues about whether Twitter's really properly monetizing its franchise in the ad space. I think a subscription model may well be something that we see under Elon Musk.
OK, Matt, thanks very much. Matt Bloxham of Bloomberg Intelligence, thanks for bringing us up to date with all the themes from tech. And coming up later today, an interview with the DoorDash CEO. That is going to be right here at 5 p.m. in New York, 5 p.m. New York time, 10 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Chrissy Gupta in New York. Matt Miller is off today. Now, Treasuries are extending gains from yesterday's close alongside the US dollar declining to its lowest level in 3 weeks. Our markets reporter Valerie Teitel takes us through the dollar's recent descent and what it all means. Valerie, good morning. Is this just some position clearing out, or do we get excited that we might once again be talking about the pivot word, P?
Yeah, and I think traders were really caught off guard by the dollar's move weaker today. There was really a lack of a clear catalyst. I've got a chart here of the last 4 days of the dollar's descent. Friday, we had the BOJ intervention in the Wall Street Journal article clamoring that the Fed might step down to 50 in December. And then 2 days ago, then yesterday, we had the weak U.S. house price data. So the fall to overnight today basically mirrors the move we've had, and there was no clear catalyst, which shows that maybe this was a positioning clear out. Maybe this pivot narrative is gaining steam. And I'm going to show you one more chart, which maybe is something we should be a bit concerned about. It is the correlation of the Bloomberg government bond index to the S&P. And my thesis here is that government bonds are beginning to trade like risk assets. And as this pivot narrative either picks up or falls away, whichever way we're headed, government bonds and equities tend to move in the same direction. Risk tends to rally at the same time bond prices increase. Now the one thing that is shocking about all of this is when this correlation breaks down, that is the scary scenario. What if we have a situation where the Fed pivot comes, but then the inflation fight it hadn't finished its inflation fight first, meaning we have a big equity risk bounce at the same time bonds fall because inflation is entrenched. So yes, we look at this and say the recent correlation is shocking, it's high, we've never seen anything like this, but to me it's the real risk is when this new correlation breaks down.
Yeah, it's a question of really if a Fed pivot is going to be bullish if it's happening because something is breaking. Bloomberg's Valerie Teitel, thank you so much as always. And of course, you can see both of her great charts at GTV Go on the Bloomberg terminal. Finally, let's take a quick look at what else is ahead today. Tech earnings will continue with Twitter and Meta reporting sentiment not great going into those prints after the disappointing results from Microsoft and Alphabet yesterday. Then it's UK Prime Minister Rishi Sunak's first Prime Minister's Questions. That's at 7 a.m. New York time. U.S. President Joe Biden will be holding a bilateral meeting with the Israeli President Isaac Herzog later today. And on the economic front, we'll get U.S. new home sales at 10 a.m. Eastern. That will be interesting after the housing data yesterday. That really was a catalyst for the bid we saw into the Treasury market. And finally, and most importantly, it is Anna's birthday today. So Anna, a very happy birthday to you from the entire Early Edition team.
Thank you. Well, I obviously know how to spend my time, don't I? What I got for my birthday is a stronger pound and some bank earnings to talk about, which is, of course, a thrill. Chrissy, interesting for markets to watch, though, what's going on in the UK politics space. I'm moving on. The UK medium-term fiscal plan, it seems, is going to, according to the BBC, now we've got another report here. So we had the Times newspaper and now the BBC saying that this fiscal plan will be delayed from the 31st of October to November 17th. And Chrissy, what's important there is that takes it beyond the Bank of England meeting, which is due on November the 3rd.
And I think what's also interesting here is at the same time, I believe we're also getting headlines that there is some suspicion that whatever plan that Rishi Sunak is able to introduce will actually be smiled upon from the IMF, which just weeks ago said it was very concerned about the UK.
Yeah, absolutely. So we'll continue to watch that carefully. And Kailey, I know we'll be watching US data. Really fascinating to see the way that the market is dealing with weakness in US data, changing expectations just at the margin around what the Fed might do, as if sort of testing the waters around that narrative.
Yeah, and you're definitely seeing that showing up in the bond market after a 14 basis point move lower on the 10-year yield yesterday. We're down another 4 basis points or so today. What's interesting is that even though bond yields are moving lower, it's not helping out equities because NASDAQ 100 futures still sharply down after those weak earnings. So we'll look to see whether that story continues with the reports after the bell, Anna.
Yeah, the big tech effect there. That is it for Early Edition. Surveillance is ahead. They'll be speaking to Mike Wilson, Chief US Equity Strategist at Morgan Stanley. What significance does he attach to the weakness of the data? What does that mean for the Fed? We'll get his thoughts shortly. This is Bloomberg.